So friends, this is again part 5 of my lecture on the accounts. So here we shall see the distinction between the tangible assets and the intangible assets. So tangible assets, they have got physical identity. Intangible assets do not have any physical identity. And the fixed tangible assets, they are depreciated. So the tangible assets are the fixed tangible assets. Whereas the intangible assets, they are amortized and they are not depreciated. The tangible assets, they can be fixed or the current assets also. Whereas the intangible assets, they usually fall in the category of the fixed assets only. And the lenders, they accept such fixed assets as security for a loan given. Whereas the lenders, generally, they do not accept the intangible assets as security for a loan given. And the tangible assets, so they may be lost due to fire and things like that, whereas intangible assets, they have got value to the company and cannot be lost due to fire and so on. So fixed assets and current assets. So that was again the tangible assets and intangible assets. And now let us see the basic difference between the fixed and the current assets. Fixed assets and current assets. Fixed assets, they are held for the purpose of producing the goods or services, and those which are not held for, resale in the normal course of business. Whereas coming to the current assets, they are in the form of cash, or they are for, they are for their conversion into cash, which can be easily converted into cash, or they are for consumption in the production. All these are the current assets. Fixed assets, they are valued at cost less depreciation, whereas these current assets, they are valued at cost or the NRV, whichever is lower. And usually the fixed assets are not subject to change, whereas usually the current assets are subject to change. Fixed assets, they cannot be pledged, whereas the current assets can be pledged. And fixed change can be created on these, fixed charge can be created. That is like depreciation value on these fixed assets, whereas the floating charge can only be created on the current assets. And the profit on sale, it is of capital nature again. The fixed assets, when you sell and get the profit, that profit also is of capital nature, whereas profit on sale of the current assets, it is of revenue nature. See, this is very important. And if the value appreciates, the revaluation reserve cannot be created for a fixed asset, whereas the reserve cannot be created at all. It can be created for a fixed asset and it cannot be created for the current assets, because current assets, the value appreciation, even if it is there, it cannot be created. And the fixed assets, they are financed out of long-term funds only, not from the short-term funds. And these current assets, of course, financed out of the short-term funds. And see, coming to the accounting standards. Accounting standards, we have already, we have very clearly explained how the accounting standards board formulates these accounting standards to establish a standard language of accounting and all that. See, very important accounting standards are: number one, the disclosure of accounting policies, accounting standard one, valuation of inventories, the cash flow statement. So how these are to be treated, what accounting treatment is to be given for these things are explained in these accounting standards. Then the contingencies and the events after the balance sheet preparation, after the balance sheet date. Similarly, depreciation accounting, accounting for the fixed assets, the effects of changes in the FE rates. So that is, FE rate again, how do you account it in rupees? Whether you take the conversion rate on the, the date, actual date on which the import or export transaction has taken place, or whether you are considering the exchange rates on 31st March, the year end. So these things are to be how these are to be treated or explained in detail in these accounting standards. Accounting for the government grants, whether it should be taken as income or liability, and under different circumstances, how you will have to account for this. Accounting for taxes on the income, similarly, the tangible assets. So, these are some of the important accounting standards dealing with these things. And coming to accounting standard one, which is very, very important, it pertains to the disclosure of the accounting policies. So here, see, accounting policy refers to the specific accounting principles and the methods adopted by the enterprise in the preparation of the financial statements. So the state of affairs and the profit or loss significantly vary from the enterprise to enterprise and within the same enterprise for different years, depending on the accounting policy you adopt. So the methods of depreciation, depletion, and amortization, they are different. There are different approved methods. So depending on that, you will have to the accounting information also changes. Say, for example, the methods allocating depreciation, there is a method called straight line method of depreciation, sinking method, the return down value method, annuity method, the depletion method or the productive method, mission hour method, etc. etc. So, going by different methods, the depreciation calculation also changes, the value of asset also changes, and the treatment of expenditure during the construction period. So the construction is still not complete. So in the process of construction, expenditure incurred, whether it should be taken as an asset or should it be considered as the work in progress or revenue expenditure, the conversion of foreign currency items at what date, at what rate, the valuation of inventory also. So valuation of inventory. So there are different approved methods. For example, the valuation of inventories, there are different methods, first in, first out, lost in, first out method, average cost method, the base stock method, specific identification method, standard cost method, and so like that. So even the next in and first out NIFO method or the highest in and the first out method. So depending on the method that you adopt, the policy that you adopt, the valuation, the value of the inventory also would be different. Similarly, the treatment of goodwill, valuation of investment, statement of the retirement benefits, whether it should be calculated pro rata every year or only when they retire for the entire period of service. So recognition of profit on the long-term contracts. Here also whether it should be apportioned every year on a straight line method or the profit should be considered only after the contract is successful and completed. The value, so the different approved methods are there as provided under the accounting standards. Then the valuation of fixed assets also, treatment of contingent liabilities. So these are all the different, I mean, policies. These are all the different areas where the policies may differ and lead to different values in different accounting statements of different companies. So let us see what is the distinction between these different methods of valuation. For example, coming to the valuation of the assets. There are different methods of, recording the value of the assets. For example, the historical cost base, the current cost base, realizable value base, the present value base, and so on. So the historical cost base means the assets are recorded at the amount of the cash paid when acquired. So the liabilities are recorded at proceeds received in the exchange for obligation. So whatever is in fact the assets are recorded at the amount of cash when purchased less the depreciation. So depreciation again depending on the rate and depending on the method. That is the historical cost. But current cost base means assets are recorded at a rate required for acquisition. So the current liability is recorded at undiscounted amount of cash. So assets are recorded at a rate if they are required for acquisition now. What would be the rate? At that rate, it is valued in the balance sheet. And the realizable value method. So the value that can be currently obtained by selling the assets. If you sell this, what would be the value? That value you take it to balance sheet. And the present value base means assets recorded at present discounted value of future cash inflows expected to be generated. So these are different methods of valuation of the assets, and the other part of my lecture you will definitely see it in the next part. So we are closing our I think this is part 5. So we are ending our part 5 at this stage. So thank you very much, friend.